Welcome, everyone. This is Blake Davenport on the LMTR podcast. I'm here today with John Del Vecchio. John is a uniquely bright portfolio manager and a specialist in forensic accounting. John always delivers an interesting perspective on trending topics and forward-thinking issues in the world of investing and the stock markets. Today is Monday, April 2nd, 2018. This is episode 3 of a series of many episodes to come, and we are extremely excited to bring you these podcasts with brilliant minds like John Del Vecchio, who are sharing some fascinating insights around the stock market questions we all want to know about. We know our listeners' time is valuable, and we want to add value to your time spent with us. So let's get to it. John, welcome, and thank you for joining us.
Thanks for having me, Blake.
Well, you know I'm a bit of a weather nut, and I see there is yet another winter blast hitting your neck of the woods in the Northeast. We just had Easter yesterday, and now a blast of winter pounds the Northeast on April 2nd. What's up with that?
Well, it seems like we have the storm of the century about every 5 or 10 days now, and so judging by my energy bills, this has been quite the winter. I don't know when it's going to stop, but I'm hoping it's soon, that's for sure. I've had enough of it.
Yeah, I bet. Is the Northeast getting a real winter for a change, or is this unusual?
This is the winter of winters, that's for sure.
John, I am fascinated with your approach to stock market investing with a strong emphasis on forensic accounting. Before we get into forensic accounting, though, tell us a bit about your background.
Well, I grew up in central New York, and I always like to say it's cloudy 365 days a year, so that's probably a bit of how my personality and my disposition developed, and probably why I became a short seller. If I grew up in Southern California, I probably would have done something completely different. But grew up in central New York and had an interest in financial markets in my teens. Started my career in the late 1990s during the internet bubble on Wall Street, and saw that that was going to be a complete disaster and that trillions of dollars would be lost. And because at that time you had companies going up 1,000% in a day when they went public, and then even after that, 300-400% in a week. It was just something I could never have imagined. And worked my way over to the dark side of the market, the Darth Vader of the market, and focused on short selling and specifically really looking at financial statements to identify the companies that were ripe for getting hit pretty hard. And so it's just a combination of the environment in which I grew up in, I think, and then also the timing. If the internet bubble hadn't been firmly in place when I started my career, maybe I wouldn't have ever thought about selling short. So it turned out to be really great timing, actually, and I've been doing it ever since.
What is forensic accounting, and how did you come up with forensic accounting as a focus and a tool to find investment opportunities and ultimately a sound investment strategy?
Well, it's just a fancy term for reading financial statements. I guess if you were called a financial statement reader, it wouldn't sound as exciting or as exotic. I've always been interested in sort of detective work. I don't watch much TV anymore, so I don't know if the show's still on, but there used to be a show called First 48, and I believe it was on A&E, and it's about homicide detectives, and if you don't find the person that committed a homicide within the first 48 hours of the crime, it's very difficult to track them down. And so I think part of my personality has a bit of that detective sort of nature to it. And really being a forensic accountant is kind of like being a financial detective. I got pretty fortunate in that I was in Washington, D.C. at the time that I really became interested in this, and right up the road was a firm called Center for Financial Research and Analysis, which was by far the most successful independent research firm in the history of Wall Street. And there were 7 or 8 people working at CFRA, and there was one job opening and a couple hundred applicants, and I got lucky and ended up with the job. And what I really wanted to do was to understand how management teams and companies could use accounting to mask a deterioration in their business, and where could I spot that in their financial statements and essentially catch them with their hand in the cookie jar. That was really my main goal more than anything else. And from there, that's really where I cut my teeth at CFRA. And they have a process that I think is quite strong and very repeatable, particularly in technology and consumer, which really were the areas that I tended to focus on. And so that's really where, again, I learned the tools of the trade and cut my teeth, and then got into asset management through an opportunity to come to Dallas, Texas, where I've been in Dallas for almost 18 years now, I guess. And managing money and finding stocks through forensic accounting are a little bit different animals, but I seem to like both and feel very comfortable in both roles as an analyst and a portfolio manager. The key really, though, is to, a lot of people will say, well, why don't you short a stock because it's overvalued? And that's why I got into financial statement analysis, because what's overvalued can stay overvalued, and what's undervalued can get a lot more undervalued. But if you can really pinpoint where management teams are being aggressive and they're essentially pasting over a trouble in their business, I think you're much closer to nailing down the timing of when an event will occur that'll lead to lower stock price. So that might be an earnings miss, a reduction in guidance. Every once in a while, we get a SEC investigation that works in our favor. And so, really just interested in the sort of detective work at hand.
Interesting. You mentioned that your expertise in forensic accounting is kind of like, you're looking under the veil, and you find these areas where the management may have their hand put in the cookie jar or caught in the cookie jar. Do you ever find that some of your work may lead to some pretty serious allegations or uncovering or maybe a catalyst of something that may be far greater than the problem originally appears to be?
Certainly, once in a while, we've definitely been at the forefront of identifying a stock. We don't get a lot of media around that for whatever reason, but certainly in the mid-2000s, oftentimes I was the originator of the thesis, the short thesis, because I was working for a man named David Tice, and I was writing research for him for institutional clients, but he was also the manager of the Prudent Bear Fund. And definitely back then it was more common for me to be the originator of the short thesis, and certainly regulators would start to take a look and things of that nature, and that can certainly pressure a stock as well. So where there's smoke, there's fire, I guess, and sometimes we find the smoke, and then the fire is kind of a little bit down the road.
Well, it's very interesting for a guy like me, as just a more of a general investor in the market. I try to use, and I think a lot of our listeners would agree, that we just try to make the best decision we can in making an investment decision, whether we're long or short. But when you look at what your expertise in forensic accounting, I almost wish there was a forensic accountant on every investment strategy team there is, because there's only so much information that I'm going to be able to process and understand before I make my decision, and that certainly would be a detail or a level of information that would be beneficial.
Well, sadly, I think on Wall Street, very few people actually do read the financial statements. It's not uncommon for me to have experienced where you meet an analyst on the sell side being one of the major Wall Street firms that covers a particular industry, just say they cover beverages, for example, and they don't really know how the company that they follow recognizes revenue, or they don't know that there was a change in that revenue recognition policy, and that the company may be using that to their advantage, and that they have a tailwind today that could be a headwind later. And it's Jim Rogers, who's a very famous investor, former partner of George Soros, one of the big hedge fund managers of all time, has said quite a bit that people just don't read annual reports. They don't read the notes of financial statements, and that's true professionally. And so that's unfortunate. And there's just not a lot of people that I think really have the patience or have developed the skill set to do so. The good news is I've created some software called the Forensic Accounting Stock Tracker that does it for you. So we can get to that at another date. But there's certainly tools that have been developed to help distill this down into some simple metrics for the average person to be able to understand.
What gets you, John Del Vecchio, excited about the markets today? And what do you really bring to the overall investment world that you operate in?
Well, I get excited about finding that next opportunity and catching someone with a hand in the cookie jar. To me, that's the cat and mouse game that I enjoy playing. I think that the market is rigged against a lot of people. So, and especially more recently, I think it's also been rigged against short sellers to a certain degree in recent years. So it's definitely not an even playing field, but just that excitement around finding that next opportunity and knowing that we found something interesting that may actually move the stock price once the general population catches on. That's what gets me up every day. As far as what I bring to lmtr.com, my focus, Brad obviously is a little more focused on technical analysis and trading, and my focus is more on fundamentals and the financial statement analysis. But I try to distill it down into easy to understand metrics. No one wants to be talked to over their head. And so I have some tools that I've created, that some of which will be for free and others not, but tools that will be available to people to help them navigate the stock picking environment, which is very challenging. Like you said, you wish that there was someone on every team that did this, because believe it or not, through full cycles, most stocks are actually losers. Very few companies drive the bulk of the performance of an index through a full market cycle. And so you kind of have to come with it with the approach of every company is guilty until proven innocent. That this isn't a court of law, and it's your money, and so you need to allocate it, carefully. With every company being guilty until proven innocent, they essentially have to prove to you that they've not been engaging in this activity to pull over investors' eyes.
John, the markets have enjoyed historic growth over the past few years especially. Do you see that this is a good thing, meaning this growth has been achieved with sound fundamentals and principles? Or do you see more growth ahead, or are you seeing warning signs that make you cautious?
So no, more and more companies are using non-GAAP measures of financial performance to present the results. GAAP means generally accepted accounting principles, and those are pretty wide, and that's a lot of gray area there. So just because someone's using a non-GAAP version doesn't mean they're, say, guilty of committing a crime or that it's fraudulent. But clearly more and more companies are resorting to those methods in order to justify the valuations that they have today. And why do they do that? Because we live in a very short-term environment where you have to beat estimates quarter after quarter after quarter to keep Wall Street and investors happy. And management teams are highly incentivized to the stock price, right? A lot of their wealth is tied up to stock, restricted stock, stock options, whatever the case may be. So it's just this big game of trying to, show results that exceed expectations. So that's gotten worse over time at a time period where profit margins have basically maxed out. So companies have essentially cut as many costs as they can out of the cost structure to drive earnings per share. And stock buybacks have been one of the largest drivers of performance since 2009 when the market bottomed. So none of this is sustainable. And what that means is that when the market does finally turn, the downside will just be exacerbated because this was all, kind of hocus pocus on the way up. If it had been, legitimately driven by strong, sustainable revenue growth, good operating metrics, companies not buying back their stock to boost their earnings per share, but to actually deliver shareholder value to their shareholder base, those would be situations where I would feel more optimistic. Unfortunately, that's really not the case. So eventually we will have another bear market. They do happen. And it's probably going to be nastier than the average one just because of what occurred on the way up.
Right. Well, that certainly opened your eyes to think, well, gosh, is there any possibility for a soft landing? Do you see that, or do you see that we're just going to have to go through a pretty tough correction?
I think we'll go through a tough correction, and then someone will step in, the government or what have you, to try to soften the blow. I mean, that's what they've done essentially the last two times, which is essentially the effect of kicking the can down the road. So we transited from, or we moved from basically the internet bubble to now all of a sudden we're going to flip houses and we're going to give mortgages to everybody that probably shouldn't have one, and then that blew up, and then we're going to bail out the banks, and then we're going to have, I did take economics in college. I've never heard of quantitative easing, so When they create a new term for something, that's usually when I get kind of nervous. So now you have zero interest rates, and in some cases negative interest rates. That obviously led to this, large move upward, and none of that's sustainable. So I don't think there will be any prospect for a soft landing. It's just a question of when does somebody step in to try to soften the blow, and what do they resort to next time? Is it like, why not just give every person in the United States of America a check for $50,000? I mean, that's probably the next thing to do, because they used all their bullets, in the last couple of crises.
Well, you talked about a catalyst or positive and negative surprises. I mean, it's certainly a negative surprise to see the mighty Facebook impinging on our security, our personal data, and being loose with it. Do you think that had an effect on the markets trying to find their footing or lack thereof?
It could, just because Facebook's a large component of the overall indexes, so it's a big component. I mean, it's not a huge component of the S&P. I think it's 1.5% or something, but it's obviously decent size, and it's certainly a company that just about everybody knows. You kind of have to be living under a rock to not know where that Facebook exists. I think that if you're going to put something on the internet, you should assume, though, that it's going to be compromised. So it doesn't surprise me when Equifax gets hacked into, or Facebook. I think they said there were 50 million. There was information compromised. Under Armour just had 150 million accounts that were compromised. Fortunately, those were just passwords and email addresses, so they weren't credit card info. But this is sort of like the daily sort of information that you're going to hear about these companies. I don't think there's anything new. It's just, you would think that Facebook would have better protections in place, and maybe they will going forward. I think the volatility issue was the bigger problem. Basically, for years, hedge funds made money every single day betting against volatility, and then all of a sudden volatility spiked, and before their cup of coffee in the morning got cold, they blew years and years of returns, and they're upside down, and that just exacerbated the issue. And that's why I think we could be going through sort of a topping process right now.
So you're kind of looking at this as the calm before the storm. It's setting up nicely. We've got a little bit of volatility. It seems like a kind of a loopy, sort of intoxicating type of back and forth sway. Indicators last week showed that if it broke down below a certain level, it should leg down another 9%, I believe I'd heard, and then all of a sudden the next day it's up and recovers most of its losses. So do you think we're going to see more of that, or are we just really setting up for a big something's got to break?
Yeah, so that type of action to me is more indicative of a topping process, and maybe we're in the eye of the storm where we've already had a little bit of a bad period in February. Things look like they were rebounding a bit. Now they're kind of headed back down. The volatility of a bear market is about 70% higher than a bull market, and there's actually more days in a bear market where the market's up 2% or more than in a bull market. And part of that reason, I think, is because people are preconditioned to try to find bottoms more than they are to pick tops. I think that's just the way most market participants, behave. And now we're seeing, last week the market was up a few days in a row with some big moves. Now it's getting hit again. That's sort of indicative of a topping sort of action. Whether or not this is the ultimate top or not, I don't know. I'd like to get through earnings season and kind of see what companies are reporting, because consumer confidence is at a 14-year high. That scares me too, because I think you should do the exact opposite of what everybody else thinks. So if consumer confidence is at a 14-year high, I'm scared to death to spend any money at all right now.
Well, next time we talk, I would like to get into if an investor buys into this concept of we're getting all the indicators are scaring me. It feels too good. A lot of what you just mentioned and more. How do I make money? How can I possibly make money, or should I just pull back into cash and just wait it out?
Right. So if the trend is up, you probably want to stay invested with where you're at, but with new money, with fresh capital, there's no way I'd be allocating to the market right here. That chart that we have on the website for the price to sales ratio of the S&P, when you're 3 standard deviations beyond the normal, you don't need to be a math wizard to figure out that that's way beyond what's reasonable. And you're at 2.5 times sales. If you're at 1.5 times sales, the forward returns are only 2.5%. So do you really want to take the risk? Do you really want to risk losing 50 or 60% to make 2.5? That doesn't really sound good to me. So with fresh capital, I definitely wouldn't be allocating. But if I've been riding this trend for 5, 6, 7 years, I'd look to tighten my stops, and then as the market starts to break through some levels, maybe you start to peel some off, for sure.
Well, your website seems to have a lot of helpful information, lmtr.com, with the sentiment updates, the market timing report, the chart of the week. You guys it's really helpful to read those weekly postings you put out.
Yeah, and we're doing that to keep people informed in real time, do it in a concise format, give them some data points that they might not see anywhere else, because we're fortunate to have access to this information, and help them sort of navigate this, because it's definitely choppy waters out there.
John, I got to tell you, we've run out of time now, but I want to thank you for being here. Next time, I want to hear more from you about what are the opportunities you think while we may have some growth here before there could be a correction, and I certainly want to learn more about the tool you've developed, Forensic Accounting Stock Tracker. That sounds very interesting, and I know our listeners are going to want to learn about that. So again, great to have you, and thank you for your time today on the LMTR podcast.
You're very welcome. Thank you.
Hey, by the way, before you go, I don't know if you've got a dog in the game, big game tonight for the NCAA men's final, but if you do, who do you think, Villanova or Michigan?
So if I were to pick a winner, it'd probably be Villanova, although I don't know that they'd cover the point spread. The point spread's 7 points, and that seems like a lot for a finals game. So I'll go with Villanova.
As an ex-Tar Heel myself, I tend to edge out Villanova because they've been pretty painful for us, so I'm going to have to go with Michigan tonight.
All right, well, good luck.
To our audience listening, everybody, thank you for joining us today. If you'd like today's episode and you want to stay informed and in the loop with new episodes as we produce them, please subscribe, review, and share on iTunes and lmtr.com. Have a great and productive day.